Hello everyone, this video is for entertainment purposes only. I'm the Canadian Dividend Investor, and on this channel we focus on the Canadian and American stock market. Many investors right now believe that the market is in a bubble and will see a recession. In this video, I'll discuss 5 companies that bounced back quickly from the 2020 pandemic crash and may be able to hold through a future recession. Stick around and see what I have for you. Between February 20th and March 23rd of 2020, the TSX took a steady decline as it dropped about 37%. For the remainder of the year, it had a slow bounce back to the point that, as of right now, we've seen an increase of just over 1% over the last year. We'll be taking a look at 5 companies that prove they could handle the drop and may be able to handle any future recessions. First company I'm going to talk about is Shopify, which is the largest company by market cap on the TSX and goes by the ticker SHOP, S-H-O-P, on both the TSX and New York Stock Exchange. Shopify is an e-commerce company that provides a platform for online stores and companies and has reported over 1 million businesses worldwide in over 175 countries. The company's mission is to help people achieve independence by making it easier to start, run, and grow their business. Shopify, which has a market cap of over $200 billion, is the biggest company on the TSX. When the TSX dropped during the pandemic, so did Shopify. However, by mid-April, they were able to get back to their pre-pandemic highs, and over the last year, they've seen an increase of over 160%. Shopify reports their earnings on February 17th, but in the 3 quarters in 2020, you can see that they beat expectations, and not just beat them, but beat them by large margins. Between the first and second quarter, the revenue almost doubled, and the third quarter saw $767 million in revenue.
The second company we're going to talk about is another TSX giant, and that is CN Rail, which trades on the TSX under CNR and under the New York Stock Exchange as CNI. CN Rail is Canada's largest railway and has tracks from the Pacific Coast to the Atlantic Coast, as well as expanding into the United States that sees tracks go straight down to Louisiana and Mississippi while going west to Iowa. CN Rail has a market cap of over $96 billion, and during the stock drop of 2020, CN Rail's share price dropped around 23%. It did take a little longer than Shopify to rebound, as it took 4 months to get back to the pre-pandemic highs. By early January this year, the share price was up around 19% from the pre-pandemic high. However, has seen a bit of a pullback over the last month, which could make it a good buying opportunity. 2020 did see a drop in both revenue and earnings, as revenue declined around 7%. This past week, the fourth quarter revenue came in, and they beat their estimate, which saw a raise in the share price by 3%. Unlike Shopify, CN Rail does pay a dividend, and it comes in just under 2% yield. They currently just raised their dividend by almost 7%, which comes in at 61.5 cents per quarter per share. And they've continued to raise their dividend every year since the mid-1990s. All right, before we get to the next choice, I'm going to remind you to hit that like button, as it helps the channel grow. And if you want to be notified of future videos, hit that subscribe button. All right, on to the next stock. The third stock that fared decently was Constellation Software, which goes by the ticker CSU on the Toronto Stock Exchange. CSU is a business that looks to acquire software companies, and in doing so has purchased over 500 businesses and mainly look for companies that target a specific industry. They currently serve 125,000 customers in 100 countries. Constellation Software has a market cap of almost $34 billion. During the 2020 stock market crash, they saw their share price decline by 20%. However, by mid-May, they'd already reached their pre-pandemic high, and they're currently trading about 10% higher than they were 1 year ago. This upcoming week, Constellation Software releases their fourth quarter earnings from 2020, and are looking to beat their estimate for the second straight month. Over the last 4 years, they've seen revenue growing and are expected to see a massive growth in earnings from 2019 to 2020. CSU does pay a very small dividend, as it's $1 per share, which comes in at a yield of just 0.25%. Back in 2019, they did pay one special dividend, which was 5 times the yearly amount. The fourth company we're going to talk about is Dollarama, which goes by the ticker DOL on the Toronto Stock Exchange. Dollarama is Canada's largest retailer that sells items for $4 or less. They were deemed an essential service and remained open during the pandemic. With people losing their jobs or being laid off, Dollarama became a very valuable store for many to use. At times, I found myself driving by a Dollarama and seeing lineups to get into the store. Dollarama has a market cap of almost $16 billion, and during the stock drop, it fell only 13%, and it took less than a month to get back to its prior levels. In the last year, it is up close to 14%. Dollarama has beat their estimate the last 3 quarters, and if you look at their year-over-year revenue, they've continually increased it from 1.24 to 1.75 by the end of 2020. Dollarama pays a small dividend of only 4.7 cents a share quarterly, which comes out to a yield of 0.37%. However, they have raised their dividend in 10 consecutive years, and over that time, it has gone up 157%. This year was the first time that they didn't raise their dividend by at least 10%, when it came in at 6.8% increase. The fifth and final company that we'll be discussing today is Algonquin Power and Utilities, and goes by the ticker AQN on the Toronto Stock Exchange. Algonquin Power is a Canadian renewable energy and regulated utility company that owns Liberty Power and Liberty Utilities. It is spread across all of North America, including 12 different states in the U.S. Algonquin Power has a market cap of almost $13.4 billion. When the pandemic hit last year, it saw an immediate decline of 37%. While it didn't bounce back right away, it did come back 30%, and for the remainder of the year, it had a slow incline, to the point that it's now at a profit from the previous pandemic high. Algonquin releases its earnings at the end of February, and expectations is that it should be their best quarter of the year. However, earnings are likely to be down from 2019. Algonquin pays a yield of 3.5%, which comes in at 15.5 cents a share quarterly. They also raise their dividend each year and have had 5 straight years of around a 10% increase in their dividend. Algonquin is one of those steady dividend payments that you can count on for passive income. All right, that does it for today's episode on 5 stocks that I think will fare well if there's another recession. And I want to remind you, I'm not a financial advisor, so make sure you do your own research. And before you leave, make sure you smash that like button. And while you're at it, also hit that subscribe button for me. Have a great day.